think's going to introduce you guys.
There you go. Let's keep Hal here and let's go to the phone.
You don't mind, do you, Hal?
That'd be fine.
Okay, double bonus time. Where are we going, Georgia?
We're going to Canton, Ohio to speak with Roger.
Ah, the home of the Hall of Fame. Hello, Roger.
How you doing, Bob?
I'm just fine. Thank you for staying up. It's the wee small hours of the morning where you are.
It's a little after 2 o'clock.
Well, we're going to make it worth your while. What's on your mind?
Okay, I got a question for Tony, of course.
Okay.
And, okay, this has to do with refinancing of a property I have. I've got a property that I used my equity in my property, my own personal property, to buy this property. Okay, and I've used an equity line of credit, paid cash for it. How should I refinance this, with a fixed rate or an ARMS, or how do you suggest?
Well, first thing I suggest you turn your television down because you're hearing about a 1.5 second delay, and that's hurting your answers. Okay.
Okay.
All right. Now, don't get an ARMS. The first answer that I'm going to tell you is don't get an accelerated rate mortgage unless you know exactly what you're doing. Unless you know that the cap, and I would never go over more than 5% from where you are, and no more than 0.5% in any one given year. Then you can't get hurt. But if you just have an open adjustable rate mortgage, you can get killed. I think fixed rate mortgages are low enough right now that you could refinance and get a 12, maybe 11.5 and a fixed rate, and you'll be happy, because I personally believe that interest rates are going to be 20 to 27% before President Reagan leaves office.
Well, that's pretty high. Okay, Hal Morris may be interested in what I did with my first property I bought. I bought it at a sheriff's sale, and I used the equity line of credit with the sheriff's sale, and it did need some fix-up quite a bit. We went in, we bought it for $18,100, and we put $10,000 in it, and the house appraised for $45,000, and we refinanced through FHA for 85% of the value. So we walked out of there after we lease optioned it for several years with about $13,700 in our pockets.
Roger, that's super. That's what it's all about. Nothing, and Tony feels the same way. Nothing makes either one of us happier than to hear you say what you just said, that you went out and were able to make some money in a real estate deal. Isn't that the way you feel?
What do you do for a living?
Roger?
Yeah, what'd you say?
What do you do for a living, Roger?
Well, I do. I work in a steel mill.
All right, that's the exciting part, because anybody can do it. Roger, you have no real estate formal education, right?
Well, not with real estate, no.
That's what I'm talking about. See, anybody can. Deals are so simple if people just forget all the fancy stuff, and if a deal gets too tough, walk away from it. There's too many easy deals out there, like Roger just talked about, that make sense, that you can do if you find a motivated seller, either in foreclosure, or the person's getting transferred, or there's divorce involved, or he just wants to get rid of it for tax reasons. Whatever the reason is,
Okay, Tony, one more question.
Quick.
Okay, after I refinance this, okay, and get it on a fixed rate and borrow whatever I can to get the cash back, FHA no longer is giving the cash back. Okay, from what I understand from the lenders. Okay, but after I go through a lender and get my fixed rate, okay, is it better to go with a lease option like I did on the first one? And, you know, that produces a positive cash flow. Is that the best way for me to go?
There's no best way to ever do anything, Roger. You have to look at your whole financial picture. If you want to sell the property and gain a long-term capital gain out of it and do it now to use that cash to buy something else, then go for that. But if you feel that you don't need the cash and you can lease option and get a positive cash flow with no risk involved, and you know, and if it's an open option where the price can keep up, then I'd say stick with it that way. Hal?
Okay, what I'm saying on this property is the property that I just bought, I paid $24,000. And it's worth a little over $40,000, between $40,000 and $45,000. It's approximately 45–50% of the market value.
Roger, it doesn't sound like you need any help from us, does it?
No, you're doing good enough on your own, Roger. Let's go on. We got to get to other people.
Good luck to you.
Okay, thank you very much. Incidentally, Johnny Carson, if you're watching again tonight, as you apparently were a couple of nights ago, you're welcome to call in California at 1-800-451-4555 if Tony or I or Hal can help you with property, or perhaps if you'd like a new girl to bring a commercial in on your program, Georgia is right here. Where are we going, Georgia?
Okay, we're going to go to Alexandria, Virginia, and we're going to speak with Phil.
All right. Hello, Phil. Good evening, and welcome to Everybody's Money Matters.
Good morning.
Good morning to you, too. It's a little after 2 in the morning up there in your city. What's on your mind tonight?
Okay, the question I had was in reference to Tony's amortization reduction.
Yes.
There was 2 of them.
Mm-hmm.
One is, isn't it better not to use that if the interest rate is currently low on your mortgage?
Okay. Well, that isn't... There's an old theory. If you're in the 50% tax bracket, should you have negative cash flow because you can write off 50%? Well, you can write off 50%, but you still got to pay on the other 50%. So I don't like that. And for the same reason, I don't like what you're implying right there. If you got a 9% interest, sure, that's better than 13. But if you can pay it off in 15 years and save $80,000 in interest, it's not as good as saving $150,000 in interest, but you're still going to save $80,000 in interest.
Yeah, see, the theory on that would be that he could get 8 or 9% on his money in a savings account, but that theory doesn't hold water.
Maybe we ought to go back to that, because a lot of people are joining us and they don't know what we're talking about.
Exactly.
And I think we can bring it up on screen.
Well, that theory wouldn't hold water either, Tony, if when you consider that you're cutting down thousands of dollars because you're projecting that amount of money, not just for that 1 year, but over the full life of the loan. So
Right.
it really adds
Phil,
up to more.
Phil, stay with me. Let's go over that so the people that are joining us can see exactly what we're talking
Okay, watch
about.
your
all right?
TV, Phil. We're going to cut you off on the telephone so you can see it on TV, and I thank you for your call.
Okay.
All right. Okay, Tony, let's go to it.
All right. Let's see if they can bring it up right there.
Okay, this has to
There we
do
go.
with
Yeah. Now,
amortization.
this is a $100,000 mortgage at 30 years and 13%. Now, what we're talking about is you have a monthly payment of $1,106.20. That's $22.90 goes to principal. Everything else goes to interest. Now, what people do is they'll pay that for 30 years. Here's what I want you to do. I want you to pay the $1,106.20, but I also want you to pay the $23.15 principal amount that's due for your second payment. You add that on to your first payment. You know what happens? You see that $1,083.05 in interest? You never, ever pay that because you already paid it a month early. Then the next month, you pay the third payment of $1,106.20, and you add on to that the $23.65 in principal. Guess what? The number 4 interest goes away. And you do the same thing every month. Now, what's going to happen? Let's take it one more step. A lot of people say, I can pay more than $22 extra. So here's what I want you to do. Think about this. In the first month, you take the $1,106.20, which is 1 month premium, and then you add on the $23.15, the $23.40, the $23.65. You pay 5 extra principal payments, so you're actually paying approximately $18 extra. Now let's go to the second one, and I'll show you exactly what I'm talking about. Can we get that second one up there? Got to hold on for a second. But what the second one's going to show is that if you made all the payments, you made 5 extra principal payments, it's only $118 extra. When you add that on to the $1,106 for payment 1, here's what you're going to get. You pay $118 extra, plus your $1,106, you're going to save $5,400 in interest that you're never, ever, ever going to pay on your loan.
That's one of the best investments you can find in the world.
You can't make that money in a bank. Then the next month, you pay $1,106, and you pay another 5 months' worth of principal payments, $126. You save $5,400. If you kept doing that for 12 straight months, you'd end up paying $1,574 extra. That's right. In a year's time, you're going to pay $1,574. That's not a lot of money extra. Do you know what you're going to save? You will save $52,628 in interest, money that you'll never have to pay to the bank. It's just amazing when you stop and think about it.
That is phenomenal.
While you're thinking about
Everybody
that,
that has the cash are doing it.
thinking about other